the top headlines that we are tracking from the world of commodities, but a lot of action is what we've seen in the agri-commodity market. Palm oil prices continue to spurge on account of a widening difference between palm oil and soybean prices, and several other soft commodities continue to remain in focus. What are the factors driving the move? Kanishka is now joining us with a roundup. Kanishka, over to you.
Two agri-commodities in focus today, palm oil and corn. Now, palm oil prices are on the rise, driven by strong demand, export demand and expectations of a weaker output from Indonesia, which is the world's top producer. A wide price discount to soybean oil has also boosted buying from key markets like India, Pakistan and Bangladesh, whereas Malaysian exports, they surged 32% in early July. Traders now expect futures to stay firm between those 3,970 to 4,200 ringgit levels. Meanwhile, corn futures on the other hand are under pressure today, hovering near that 9-month low at around $4 per bushel. Now, the drop comes amid uncertainty over US tariffs targeting major agri-trade partners like Japan and South Korea, and also favorable weather conditions in the US and South America. Now, volatility remains high as traders await clarity on potential trade deals. Now, with global demand, trade policies and weather all in play, palm oil and corn are on traders' radar today. The focus, of course, remains on what comes out of the impact of the latest tariffs announced by Donald Trump.
So corn prices are trading at multi-month low levels, but on the flip side, we have palm oil prices which are surging in trade. Kanishka, thanks so much for joining us with that roundup. But shifting focus to the yellow metal and oil market, first up, let's put the spotlight on Brent crude, which is sitting with a cut of nearly 0.3% as we speak after a solid 2% surge that we saw in yesterday's trading session to trade near that $69.3 per barrel mark. Now, several factors are at play for the Brent market. One, of course, is US tariffs, where we're seeing escalation in hostilities in Red Sea, which continues to impact the oil market. There is a fragile truce which is in place between Iran and Israel, but any kind of disruption in Red Sea is again likely to weigh heavy on the oil market going forward. Apart from that, OPEC Plus, a decision which came over the weekend to hike output by 550,000 barrels per day, also continues to weigh heavy on the oil market. But let's also put the spotlight on the yellow metal then. Spot gold. Currently, it is trading near that $3,330 per ounce, and several factors at play for gold as well. Concerns about growing US-led trade war continue to weigh heavy, and there are expectations that perhaps safe haven demand could be fading for the yellow metal, because of which it is now steady near that $3,330 per ounce mark. But let's keep it going with the bullion market then, and it seems that the glitter may be losing some of its shine. Gold prices have had a phenomenal run, rising nearly 25% this calendar year so far, after clocking a solid 27% gain that we saw in calendar year 2024. But if brokerage reports are something to go by, the rally may be hitting a roadblock. In its latest note, Motilal Oswal Wealth Management says that signs of fatigue are now emerging in the yellow metal market, with risk premiums from geopolitical tensions easing and trade-related uncertainties subsiding. The safe haven appeal of gold appears to be now weakening. Experts now believe that fresh and significant catalysts will be needed for prices to advance from the current levels. So is this pause or a reversal for gold prices going forward? To discuss exactly this, we now have Mr. Manav Modi, Senior Analyst Commodity Research at Motilal Oswal Financial Services, now joining us. Mr. Modi, thank you so much for taking your time out and joining us here on ET Now. If you can elaborate your note for us, you're saying that perhaps we are seeing some signs of fatigue in the yellow metal market. What are those signs, and does this mean that you expect prices to remain stable, or perhaps they could fall from the current level?
Thank you for having me. Definitely, to answer your question, is this a pause or a correction? I think we could see some bit of correction from here going ahead, because the factors that we are discussing, trade tariff or trade talks deal that President Trump is currently pushing through with all the countries. He's already agreed with a lot of countries. A lot of letters are already going through. The tariff on South Korea and Japan of 25%, that also also did not lead to much of a rally or much of a push to the safe haven asset. Definitely, some more triggers or some more catalysts are required for a new rally or new high for gold from here on. We have been talking about, or we have been seeing since the start of 2025 that gold has been rallying continuously. I mean, in the first 4 months, we were already up by about 30-35% on the this year's percentage gains. Also, one of our analysis also says that. On COMEX since the year of 2000, gold has not breached the 32% gain mark. So that ideally looks like that this is some number that gold could take a halt, could consolidate in a range, give some buyers ease off and a good level to buy in. Also, if we see the central bank gold buying, we've recently seen a report that central bank are still a net buyer, but the overall pace has been reducing significantly. China, who is a buyer for since the last 8 months, is buying hardly 2 tons, 3 tons on a monthly basis, which is a very narrow number. One big reason is Fed rate cut, currently not in picture. If the rate cut, delays or rate cut is not really there, that could ideally push the prices further down. And on the domestic front, I think USD INR is also one of those factors, which is rupee appreciation basically is keeping the domestic prices on the lower end.
Understood. So you expect gold prices to consolidate or remain range bound at least for the near future. But your report also says that for gold prices to see an uptick, we need fresh triggers and fresh catalysts. If you can tell us more, what kind of triggers could help gold prices break out of that $3,400 per ounce mark?
Absolutely. I mean, as mentioned that on a longer term scenario, if I talk about 1 year, 2 year scenario, definitely the prices could continue to inch higher. But as of now, in the near term, the overall exhaustion is felt in the prices. The overall catalyst one could be the Fed rate cut coming in sooner than expected. One rate cut, we are Fed according to the dot plot, we are expecting two rate cuts in this year, one in 2026 and one in 2027. So in 3 years, there is only four rate cuts which the Fed is announcing. If this number of four increases or rate cut possibility increases for this year or the next year, gold could get a significant support. We are already talking about the debt bubble in the US. If that kind of burst or the trouble related to debt comes in sooner, the sooner with respect to the tax cut bill, also that also could be a catalyst for gold rising. We are talking about economic numbers. That is a third and the main scenario, that labor market is not at all giving up. There's resilience there. So if the labor market also kind of gives a loosening scenario, that could be equal to lower inflation, lower growth, and now lower labor market could be one of those catalysts. So I think these three are the major points. Apart from the geopolitical tension and the President Trump's risk factor, these three are the major catalysts which could add those triggers that we're looking for.
Understood. So those are several triggers that could perhaps take gold prices higher from the current level. But since you spoke about central bank buying, that it has slowed down a tad bit over the last few months, how much has the decline been, and how much of an important factor is central bank buying in determining the pace of uptick that we could see going forward?
Definitely, if you talk about just this year, I mean, central banks has bought more than 250 tons in the first quarter, so as to speak. If I just talk about the last year, since the pandemic, the central bank buying has increased anywhere between 700 to 1,000 tons. In this year, start of 2025, the pace, the main central bankers have been missing, they who were active last year, which were Russia. India was a significant buyer, that is the RBI. China was a significant buyer. Other Middle East countries were, there. But in this year, RBI has bought very, minimal amounts of gold in their reserves. China has also slowed down. They are in the first 2 months, they were only, significant amount. But in the last couple of months, that is 2 or 3 months, the buying has to the tune of 2 or 3 tons only. So they continue to remain a consistent or a net buyer. But then if every year they bought say 700 or 800 tons, this year could be a tad lower than that.
Okay, so central bank buying of gold is likely to decline this year. That's the word coming in. Mr. Modi, thank you so much for taking your time out and joining us here on ET Now and helping us understand what the outlook is for the yellow metal market going forward. Thanks so much.
Thank you
But
so